Okay, hello everyone and welcome. Good evening. We are so excited to have you all here. Today we have an esteemed guest among us, Mr. Sunil Goyal. He is a seasoned veteran player in the startup and VC space. So whether you're a finance enthusiast or a startup enthusiast or you just are curious about the VC space, this is your chance to interact with of the best in the industry. Thank you so much for coming, sir, and we can't wait to hear your thoughts.
Pleasure. Aha. I've been here for last 1 hour, walking around the campus, getting the feel of the energy that all of you have here, and lots of activities that you get to do. And a session like valuation is what picked up by you, and that too at the undergrad level. You know, it amazes me that at such young age, you are trying to understand a subject as complex as this, and I hope I'm able to make it simpler, easier for you. I was looking at one of the speaker lists out here, and challenges come in life, and I had one big challenge when I was working for Bharti Airtel. And we wanted to buy one company, and the value of that company that we wanted to pay was 400 crores. And the person who wanted to sell the company, he wanted 1,000 crore valuation. Look at the gap. I want to buy it for 400 crores. Somebody wants to sell it for 1,000 crores. How to justify, how to make it happen? How do we get that transaction done? And still, one of the speakers, Jay Kumar out there, he came as a banker, sat with me, and we were able to close that transaction. Okay. So the never give up attitude is there if you understand this particular concept. And why each one of us need to understand this concept of valuation. Is intuitively you feel that if you have to do a startup and you have to raise money, and hence you should understand valuation. No. Everybody of us, because you're going to go and join one multinational corporation, one large corporation, and you may be compensated in what form? Employee stock options, ESOPs. You may be given by international company, RSUs. Okay, so residual, the stock units of international companies. Now, when your compensation is linked to these stock options, how do you value them? You're going to get let's say, $1 million. The person says you have $1 million salary in Google that you're going to join. But that $1 million has $600,000 as stock options. So how do you value them? That's one. Let's say some of you are going to be going into consulting. If you're going to join a consulting firm, the client of yours is only going to be working with you provided you can enhance the value of their company. Otherwise, that client is not going to be there. So how are you going to be helping your clients to enhance the value? And if you're going to be joining a venture capitalist like me, our salaries, our income are very low. We only make money when we sell our businesses. And we get a share of that capital gain from there. That is the business model of a venture capitalist. So anybody who joins a venture capitalist, the money comes in after 8th or 9th year in your pocket, not on every monthly basis, or an investment banker gets the money every now and then whenever a transaction happens. So one needs to understand what is that hidden value of the portfolio companies that a venture capitalist has, and what money that you can make after 7, 8, 9 years by holding that asset. So this is the reason the topic of valuation is going to be relevant for each one of us. What do I do? YourNest. What we do? We buy companies, we take stakeholding in the company, partner them, and after a few years, once they grow up, we nurture them to become market leaders in their space. We sell that company. So we have to buy them at the right price, and after 5 to 7 years, sell them at a very good price. That is what we do. And the reason I enjoy that job, because we are trying to nurture some global market leaders from India, and that is what we do from our third fund. And, before coming over here, I was thinking as to how I step back to my youth, to the days that I was in college. not only the reason I'm speaking to you today is I have done portfolio management during my master's. Portfolio management is a topic of valuing shares and seeing which shares to be held with you. And then I worked for Dabur for 10 years and Airtel for 10 years. All through my life, it was always about mergers and acquisition, launching new products, creating value or so for our shareholders for which we were working. So those are the examples that we'll be sharing today with you. So today, what we'll understand? We'll understand the concept of valuation, how value is different from price, what are the different ways to arrive at a value of a particular asset, when and why do you need to do the particular valuation, and in a life cycle of a company, whether a startup stage, they are early stage companies, how do you value them? When they are listed companies, how do you value them? When they're a mature business which are not growing, how do you value them? So all those examples and illustrations is what we are going to be looking at today to learn this particular subject. Yes. 100 rupee note in your pocket. 100 rupee note in your pocket. This is the only certain value. Whenever you have to arrive at a value of an asset, if I ask you what is the value of a 100 rupee note in your pocket, it is defined 100 rupees. To the extent, this is the only science that scientifically that the value of a 100 rupee note is a 100 rupee note. And if you have to convert in US dollar at that particular point in time, you need the exchange rate. And you can say in US dollar, this is the value of that particular currency note. And let's imagine that you bought a bottle of water with that 100 rupees note. Now, what is the value of this? Imagine if you have to resell that bottle of water. Will you be able to sell it for 100 rupees? May not be, because the person will go to the shop only and he'll say, I don't know what tempering you might have done with this particular bottle, so you won't be able to sell. That value of that particular thing is what we have to now determine. And what a businessman does to create value from here. Create value from here, how? There is a glass of water which is available on the roadside. Okay, there is a certain value that we pay for that. The thirst quenching capability of all those 4 branded products is the same. While the functionality of the product is the same, the perceived value in our minds is different. And now, how do we calculate that perceived value of an asset is the art. And a businessman makes money out of it. The same glass of water available in a desert or on the high seas is going to be priceless. So how do you value that at that particular point in time? And then if you're trying to brand it at a particular manner, you're creating higher valuation. Means if one is available 15 rupees, that is 30 rupees, the other one is 60 rupees. There is a story behind it. There is something that the businessman is creating around it. So while the water is available in the same place, there's a different value. Okay, so it is like you have a real estate property. One is facing the main road, one is facing the park, one is not facing any of these things. There is a perceived value, whereas the living condition and the living standard is going to be will be the same. This brings us to as to how that value is assessed. Let's take an example of a rented property. Simple thing. If there is a house, there is a rented property out there. The value of that house you will determine basis that during the time that you're holding, what rental income you're getting. Very simple. Every year, what rental income you're getting. And if you sell after 5 years, 7 years, what value you will get. You just add that cash flow, that perceived cash flow, and that you arrive at the value of that asset. Very, very simple way to understand the concept of valuation, that what is the during the operations, what kind, if you're holding a share, till the time I'm holding a share, what kind of dividend income I'll get, and after a particular point in time, when I'll sell that share, what could be the potential price of that share, basis that you drive at today's value. So that's the one aspect of understanding value. since I gave the example of share, understand the price of a share may not be equal to the underlying value of the share. For example, the price of a glass or bottle may not be same as the value of that particular price of the bottle. Because if you're thirsty, then even if the price is 60 rupees, for you is worth maybe unimaginable amount of money. So how do we trade in shares? Why do we trade in shares? Because somebody thinks the underlying value of the share is much higher than the price that they're currently trading at. And that is what, valuation gurus keep on, Aswathama Sahab keeps on teaching us, that that's the way the valuation has to be arrived at. The opportunity is for you to assess that the underlying value of Zomato share is so high that whatever market is paying, I know as a brand user, I'll continue to use Zomato for my life. And they're meeting my need. Hence, I believe I must hold Zomato shares today also, and maybe more beyond or so. We are familiar with the interest rates. Interest rates, when I say that you're going to be earning 10% interest rate, what does that mean? The word out here is compounded annually. So 10% of your principal amount will be annually earned by you. So whenever you talk about valuations, the return is seen on annual basis. So that's the first thing that you have to look at. Are you familiar with the concept of internal rate of return, IRR? Okay, if I say that I made a profit of 15% on the shares that I've held, that means I've earned 15% year on year on year. And if you have to arrive at the value of the asset, cash flow year-wise, year 1, year 2, year 3, year 4, and the last year when you're selling that asset, when you say that I don't want to hold that asset anymore, what is the terminal value? So today, in this particular interaction with you, I'm going to be introducing many concepts and many vocabularies for you, but in an easy manner for you to understand. So moment you know that there has to be a terminal value, which you have to then discount to be arrive at the current value of the asset. Okay? So, and simple example is for us to understand is a rented property. If I'm owner of a house, I know how much rental I'm getting and what price I can sell in future. Basis that I can arrive at the current value of the business or so. The last concept on valuation. One, valuation is never static. It is changing every minute. And how does that change? What is the ingredient that makes the valuation change or a valuation be there? This story of Apple, everybody knows. The important aspect is, in the story, you are selling a promise to your customers. How solid it is, that promise. And in that particular promise, what proposition you are giving to the customer, and how differentiated is that particular proposition is the part of the story. But story is not just enough. Every promise, if you start keeping that promise, if you start meeting that promise, that means you're able to demonstrate execution. Okay, if you're able to demonstrate execution and deliver numbers out there, that means you're delivering revenue, delivering EBITDA, etc., the profit, etc., then it's a true story. Then the valuation comes in. And that valuation keeps on changing and increasing every now and then. And for us, when we meet a founder, when you'll bring a startup to us for us to fund, we will only see, when we are interacting with you over a period of 3 to 6 months to invest in your startup, whether you have kept every promise that you've made. If you kept your promise, you have, that means uncertainty is lower. That means there is variability in your prediction is lower. You're more predictable. If you're more predictable, risk is lower. Because risk is lower, I'll pay higher price to you. I need not have the higher rate of interest expectation or IRR expectation would be lower because risk is lower in that business. Simple. Predictability means lower risk. Lower risk means lower expected return from that asset. Before I go to the next chapter, any questions, any clarifications? And I've got Pranav who has helped me with the this presentation. If you can interact with him during the session as well as otherwise, please. Internal rate of return is in any asset. If there is a price that you've paid, let's say you paid a price of 10 rupees to buy a share. And after 5 years, let's say you've sold it for 50 rupees. Now you made the money 5 times. So you have to now calculate the internal rate of return out there. That means if you have put that money on interest in a bank or with somebody, how much interest you would have intuitively calculated for the money to become 5 times in 5 years. So if I get, let's say, 100% interest, okay, assume for the same call, the 10 rupees would have become 20 rupees in the end of the second year, in the first year. In the second year, it would have become 40 rupees. So now it is taken 5 years to become 50. So that means the rate of return IRR is less than 100. Now we do a calculation. Let's say the IRR is 50%. So 10 rupees becomes 15 rupees after 1 year, then become 22.5, then another 50% jump, let's say 33 rupees, then it becomes another 16 rupees. So in 4 years period, it becomes 50 rupees. So IRR is, that means higher than 50%. Very simple. I've just given a simple tool to you that in this example of money becoming 10 rupees to 50 rupees in 5 years time, the IRR would be somewhere around 55 to 60%. That means if you would have kept that 10 rupees with somebody at an interest rate of 55%, you would have made 5 times money in 5 years. Okay, simple this thing. And there is a rule of 72 out there. So rule of 72 is a very simple rule which actually helps you compute this particular number very, very quickly. The example that we gave, that the 10 rupee invested by you became 50 rupees in 5 years. The external rate of return is that the 10 rupees, if you would have invested somewhere else, what would have you earned at that particular point? And internal rate is where you made the investment, what return that you made it. Okay, so whenever I talk to my investors, what I say, my IRR is 36% as a fund. Okay, so I excite them to come and invest with me. And I also tell them, if you would have invested in NASDAQ or you would have invested in NSE, you would have only made 11% or 12%. So that's the external rate of benchmark return.
Is it the next best investment or the average?
No. It is the next best in the mind of the investor. So you say, okay, I'm investing 10 rupees here, but if I would have invested somewhere else, what would have been that I missed that opportunity? I did not invest there. But what would have been the external rate of return out there?
ERR can differ from person to person.
Obviously, because internal rate is for that asset, for that investment at a point in time.
One last question. Could you explain the terminal year concept?
Yes. See, terminal year. No, it means you can be holding that asset for life also. If you're holding the asset for life, you don't need to compute the terminal value. But after a point in time, you have to say, yeah, this particular asset will be a normal growth asset. The rental income will be same. I've invested in a high growth, hyper growth Zomato, but after a period of time, this will start growing along with economic growth. So because it will grow along with the economy, I can now compute a terminal value to that. So terminal value is the value at which you will be selling that asset. Okay, at that point in time, 5 years later, 6 years later, 10 years later, and that is the time until which you will compute the annual return.
Thank you.
Go ahead.
Hello. Yeah. In today's age, are FDs still considered like a reasonable ERR to with which everything was compared? So is that changing now?
It is never going to change. Okay. Risk-free return is what most investors look for. So risk-free return is, which is guaranteed that it is not going to fail. Even in the FDs, there is a risk. because I don't know the bank will fail or not fail. Okay, at the point in time when I need the thing, there could be certain risk. So you have to choose the bank where the risk is going to be low. But still, this is going to be always irrelevant. Most important risk-free return is government bonds, which is what government securities that we buy. So government security, anybody knows what is the current interest rate available? Yes, it is around 7.4 or so at this particular point in time. This has started going up in the last few years. So 7.4% is what you earn risk-free on a government securities, because we believe that the government is not going to be defaulting. There are some tax-free where the return will be even lower.
I had a question. Here,
Yes.
when we calculate the discount rate, we look at the risk premium and the beta unlevered value as well. How are those derived? Like, how do we calculate them?
Yes, I'll come and talk about it, because now he's complicating the life. Okay, I'll step by step come on to that. Yes, we will cover that, because there is a certain amount of risk that is perceived in every asset. So basis that the discount rate is computed, we will talk about it in a while. Anything else before when we go into a little bit more of a startup? Yes.
Particularly for startups, while valuing startups, especially in their early years, they won't be generating any cash flow. So then how will it be like an accurate model of valuation for startups? It could probably work for like big MNCs or companies which have been generating cash flow for a while, but especially for startups wherein, in tech, the valuations are much higher than the cash flow. So will this model work?
Very pertinent question. This is the reason we say valuation is neither a science nor an art. Okay, because there is, so it will be a science if there is a predictability of cash flow, input is put in, and the output is going to be consistent. It is like the law of physics and mathematics that every time the result is going to be the same value. It doesn't happen like that, because we don't have firm cash flows and firm terminal value out there. Even this is not an art. The valuation is not an art, because art normally you have to work very hard to be able to excel in that particular art, and maybe you need to be born with that skill. We say it's a craft because it's a skill that can be acquired. So how do we acquire that skill? Even if the company or startup is not going to be making losses for the 5-10 years, there's not going to be any cash flows. We keep looking into the future, that when it will start making cash flows, how much will be those cash flows? So we may look at 5 years down, 6 years down, 10 years down, but we'll assume that the cash flows will start some point in time, and those cash flows are discounted until that point, and then the perception is built. Okay. Another 100 rupee note is back here. Okay. Back here to give you an example of a terminology that you will hear again and again. The terminology is pre-money valuation and a post-money valuation. What is this? Let's say you have 400 rupees in your pocket, in your startup, in your company. So your pre-money valuation is 400 rupees. And now you get Sunil Goyal, YourNest, to come and invest 100 rupees with you. So I've invested 100 rupees with you. Your company's worth is now 500 rupees. So the post-money valuation is 500 rupees. And I am getting a share of 20% in your company. So did you get? When you have accepted my 100 rupees in a company which was having a value of pre-money valuation of 400 rupees, by accepting 100 rupees, now you've diluted your shareholding. Until that time, you've not accepted my money. You had 400 rupees, you were 100% owner of your business. After taking my 100 rupees, now you're only 80% owner of your business. 20% belongs to me. This is like saying that you are an entrepreneur, you work for the rest of your life, and whatever money you will make, 20% share of that profit will come to me. Imagine this is what we do as a venture capitalist. Once you become a founder with us, we say, I'm putting money in you, and From now onwards, your own time and attention will go to that business only. You can't do anything else. And in that business, by giving that 100 rupees, by taking that 20% share, I become the part owner of your future profits and future endeavors. This is what the venture capitalist is looking forward to do. So simple, pre-money, post-money, and a fresh investment coming into the business. I believe you will never be confused about this concept. Now, the startup could be idea stage, whatever stage. How do we value that, and what goes into valuing those startups, that company? Can you describe which economic cycle is the world economy going through right now? Somebody can describe the current economic cycle. Okay. Rising is then interest rates are rising right now. Yes. That means the market is booming so much. The market is expanding so much. We are all spending so much of money that the government is trying to control the demand by enhancing the interest rates, so that instead of spending money, you put the money in the bank account. Because inflation is on the rise. Despite interest rates going up, still the demand for oil, demand for everything is going up, and hence market is expanding. And once the market is expanding, to cool it down, interest rates are taken up. And when the interest rates go up, monies to invest with people like us becomes lesser and lesser. Because what do the people do? They say, no, I don't want to put money into the risk capital like us. We will put money in FDs. I'm earning 5.5% dollar return. The LIBOR rate right now is 5.5%. I'm earning 5.5% on dollar return. I don't want to put money with any startup. I'll only put money in the bonds. So that's the scenario that is going on. There is a tightening of money going on. Until 2021, we were flush with money all across. Because we were flush with money, how was the economic cycle scenario? Okay. The economic cycle scenario at that particular point in time was, there was the economic cycle was primarily that there was so much of money that we wanted to buy every asset. Every family office we used to go, they used to say, I'm investing in this and this and this startup. And today I go to them, no, I'm over invested. I can't even look and meet any startup. And the worst part is, today is the time to invest in startups. जब भेड़ cycle होता है, जब psychologically everybody is investing, the asset prices are very high. So asset prices were peak in 2021. All IPOs, Paytm, Zomato, every IPO got listed at billions of dollars market cap, and they crashed subsequently just because of this particular reason, that there was oversupply of money. Today, there is least money available, best value to invest, and people don't have money because they've over allocated their assets already in the earlier scenario. From the from these trends, whenever there is a positive economic cycle, the valuations are higher. When the market condenses, the valuations go down. Similarly, did you look at some regulatory changes? Any idea of which shares did badly because of some regulatory reason in the last 6 months to 12 months? Some examples you can give? Some shares would have gone down dramatically, or gone up dramatically because of some structural changes around. Perfect example. So he's given an example of Dream 11. Now, until the time that regulation came in, the regulation was goods and services tax, GST, was levied on the money put in by you in the gaming company versus the money that was won by you. Okay. So until this regulation came, only the money that you happen to win, on that the GST was levied. Now the money that is put in by you in the bank account of that Dream 11, on that GST is levied. That means huge loss to customers and them. In one day, the share prices fell 30%. So valuations change because of any regulatory changes or structural changes. Today, why Indian market is at peak? It is best performing market everywhere. All of ours are doing SIPs out there because there is a structural belief that the youth of India will continue to join workforce. More and more women will start working on working. Urbanization will keep on growing and multiplying. So we believe for the next foreseeable future, India structurally is going to be doing well. So those are the examples that come in. And hence, whenever that environment is there, the valuations go up. There was one environment 4 years ago, one very, very crucial asset of ours. The value for one day became negative. We watched that oil, the crude oil prices became negative for one day. Whoever was holding that asset, why it became negative, anybody can explain? Yeah. That's it. There was no storage available for the delivery of crude oil on that particular day. The cost of storing crude oil after taking delivery was much higher because the demand was not there in the market for crude oil, and hence the oil that we are buying at $80, it was negative $20 or so for that particular day. So that's how the prices, because of, we know the crude oil is important, but look at the environmental factors. Those environmental factors change the valuation at any point in time. Any clarifications here before I move on? So there is another factor. The factor is, what stage is your early stage business? If the earning potential is the same, but if it is idea stage, we will give you a very low value. If it is an incubation stage, any idea what is the difference between incubation stage and an acceleration stage? Prototype, yeah, there is an MVP. Okay. So, but there is an MVP in case of accelerator or incubator? Incubator. What happens in case of accelerator? Yes. When you go to an incubator, you go there to make a product out there. So you just are doing a product. This idea is there, transitioning that to a product. Once the product is ready, you go to an accelerator to decide who to sell to. So product market, you can say PFM, product market fit is established. Who to sell, at what price to sell is determined when you're within accelerators. So the valuation in these three stages is very, very low. As venture capitalists, we start coming and investing at a pre-series A, series A, and growth stage. And each stage is different. At my stage, when I invest in a pre-series A stage, I only need customer validation. There is a risk of technology, there's a risk of team, there's a risk of market acceptability. All those risks are there in the business, except that there is one customer or few customers who are saying this product is ready to be bought, and I start writing a check at that time. And what we work for a Series A investor to come and invest. So you understand Series A, pre-Series A, Series B. Okay, this is a very stages. And in Series A, we try and eliminate at least one risk, that the team risk is behind. Maybe to an extent, market acceptability is behind. Maybe technology risk is lower. And the Series B comes in when the person says, even market has accepted the product. Okay, so the team is stable, market is stable, technology is accepted. They've been able to win versus competition. And then comes Series C, which is like a ultimate growth, when every Tom, Dick, and Harry starts investing in that company, because by then, most of the risks are behind. Now they've seen, oh, this business is even scaling up. Okay, scaling up month on month, year on year, on its own. There's no competition around there. That's the time the Bhed Chanta comes in to start investing in a startup. So depending on the stage, the valuation could be different. Let me give some examples. If I have to value a business at idea stage, there was one company that came to us with an idea that said, in 15 minutes, we will be able to recharge the electric vehicle battery, which takes 6 to 8 hours. Now, all my techies, PhDs, etc., they said, impossible. This is written in the books of physics for years and years. Nobody in the world has been done. How can an Indian Bangalore-based startup do it? Okay. Now, what do I do? This person says the valuation of that company. He says, can you invest $3 million at a valuation of $15 million? I said, boss, I don't even know whether you'll be able to achieve it or not, do it or not. How can I invest in that particular stage? Now, how do I value a business like this? No, if you have a bright idea like that, I said, don't take $3 million from me. Take 600,000, take $1 million from me, but at a valuation of I gave, I think, $3.7 million valuation. So because it was an idea stage, we invested at $3.7 million at the idea stage. It was the right time. In 6 months' time, on the lab level, at your incubation lab, he demonstrated the product can work. We invested the next check at $17 million valuation. In 6 months' time, he gave us one running prototype in the Bangalore street. We've invested at $45 million valuation. Okay. And then now he's demonstrated 40 charging stations in Bangalore with thousands of vehicles running out there. We are just investing in them at $100 million valuation. No profits in the company, nothing. Now I've given an example of an idea stage business. So the idea, the aspiration of the entrepreneur has to be that the idea is clicking with you to be able to invest. Research. How deep the research that have you done to be able for us to invest in that particular segment that you're unique. Research married with product. I'll give one example to you. Have you heard of a toy or a robo called Miko? Anybody? Okay, few of you. Miko is a companion robo for kids between the age of 4 to 8. And it is for overall development of child. It plays, it actually initiates discussion with the child also. AI, 35 sensors, lots of innovation out there. IIT Mumbai student came with us with a product. And when we looked at the product, that product had a similar company in US, which was valued $700 million. They raised nearly $200 million from the market. And here I was evaluating this idea in 2017-18 that should we invest in that company or that particular global company will eat away the market and hence we shouldn't be investing in that company. But the market research this gentleman had done and the product roadmap that he showed to us was of 10 years. Imagine somebody in an AI world, in an IoT world, in a robotics world, showing us a product roadmap from 2017 to 2027. And in that particular roadmap, telling us that AI will evolve like this, IoT will evolve like this, sensors will come, this will come, this will come. And around that time, I'll have this product feature added. He had a complete product roadmap for 10 years. This gentleman was from IIT Bombay. In the 60 years of history of IIT Bombay, he was the second person to get into Hall of Fames and had represented India in various robotics competition. We wrote a check at $4.8 million valuation. And in a year's time, he launched Miko 2. We wrote a check at $22 million valuation. In next year's time, he launched the product in global markets, US and others. And we wrote a check at $88 million valuation. And then now he has around customers in 150 countries. I keep saying Steve Jobs gave smartphone to the world. Sneha Vaswani of IIT Mumbai has given robo to the world. That's the powerful statement that I make. Okay, that's the quality of robo that has come from India. And today it raised the capital at $200 million valuation. So that's the kind of things that we look at. On partnership, again, what kind of partnerships are you signing? The value is created from there. You can't do everything alone. I was with Bharti Airtel. We happen to say, network is very, very important element of any telecom company. And IT is also very, very important element of a telecom company. We happen to outsource all our IT, software development and managing software to IBM. It was $1 billion contract. We happen to outsource all our networks to Ericsson, Nokia, and Siemens. We said, you know the best. I only know how to manage customers. Look at the trust that we had in our partners that even a US-led company like IBM will not cheat us, will not backstab us. It is going to be equally vulnerable if this project fails. So if our IT stops working, yes, we will fail. But IBM also is equally vulnerable because it's the first contract of that particular size they are signing worldwide. And if they fail, they won't be able to survive as a company, or they will be impacted largely. So partnership has to be done in a right manner. And then the startup must know how much money is required. The example of Exponent Energy, which is 15 minutes recharge, the person said, I'll take $1 million, and in $1 million, I'll prove in 6 months' time this product works at the lab level. So he knew how much money he needs. Because he knew how much money he needs, his aspirations are today fulfilled. So the aspiration of an entrepreneur is very, very important for us to know if the vision is very, very powerful. Another company that I must talk about the vision out here. Okay, there must be another slide also to talk about vision. Okay. Another thing that determines valuation is differentiation. We all know product has to be different. Okay. Everything does the same job, but how unique you're there from the rest of the market determines the value. Here, I'll give another example. There's a company called Dozy. They came to us and they said, we will, when you're lying down on the bed without touching human body, we will be able to track all health vitals. So without touching human body, we will put the strip of sensors under the mattress, gadde ke niche, around your area of chest. The way you breathe will be sensed by those sensors, and we'll be able to predict whether there is going to be a heart failure, not failure, means whatever, your blood pressure is higher or lower. Innovation are happening after 400 years to measure blood pressure. Now, such kind of innovation, such kind of product differentiation, today everybody has to wear a wristband to be able to know, and that is expensive. Okay, this person is doing for a peanuts cost at some 500 rupees a day in a bed, or for a bed in a hospital, and 300 hospitals are doing it. Product differentiation is another unique reason for a value to be higher of that business. I saw when I was going around, there was one, your alumnus has started one cafeteria down there. Even if you get the opportunity to start a business and there's a confirm order coming in, don't start the venture until the time people better than you, more intelligent than you, are ready to sign up and become partners with you. It is the quality of team around you that will determine the value of yours. So the quality of leadership team is what we assess. Market opportunity, I've given enough examples. Problem statement that you're solving, let's say I gave that example of Exponent Energy. Vision of the company. How powerful that vision is, what you want to do. Dozy said, we will make her bed Dozy bed. So every bed in the hospital will be a Dozy bed. If that is going to be there, we are going to be replacing Siemens and Philips from all hospitals worldwide with that particular technology. Obviously, the vision is powerful for us to be able to partner with such a company. So these are evaluation criteria, and it'll be good if you get to know and study more about it. And in lieu of what we get it, as a founder, what do you need to give up? The same example of you have 400 rupees in pocket, you have to dilute 20% of the company, 10% of the company, the valuation matters there. So if I'm investing $1 million and I'm asking for 10% stake in the company, that means I'm valuing you at $10 million. But if you think your valuation is higher, then you say, you give me $1 million, but only for 5% dilution. So my valuation is $20 million. So those are the examples that come in at the dilution level. And if I'm coming in as an investor, what is my business model? Anybody can explain the business model of a venture capitalist? Somebody, some idea. Yes, go ahead. Business model of a venture capitalist.
Through carry.
Okay, explain carry to them.
So whenever, let's say you invested in a portfolio company and that goes public or that gets acquired by another company, the amount for which it sells, VCs get a percentage of that money for which it's sold.
Yeah.
And that's called carry.
Perfectly fine. So the business model is actually, we keep saying your business should be understood in a very simple language. Okay. When I started my venture capital firm in 2012, I remember my Buaji's two friends from Ludhiana came, and they were 80-year-old ladies sitting on the drawing room on the sofa, and they asked in Punjabi, "Beta, tu ki karda hai? What do you do?" And I had to explain to them in one sentence. मैंने क्या जी मैं ना ਜਿਹੜੇ ਬੱਚੇ ਨਏ ਨਏ ਬਿਜ਼ਨਸ ਸ਼ੁਰੂ ਕਰਦੇ ਆ ਉਹਨਾਂ 'ਚ ਹਿੱਸੇਦਾਰੀ ਲੈਣਾ ਤੇ 5-6 ਸਾਲ ਬਾਅਦ ਹਿੱਸੇਦਾਰੀ ਵੇਚ ਦੇਣਾ they were from business family. They understood that in bright boys and girls, I take equity stake at the early stage, and in 5-7 years, I make them big and sell that stake. I'll tell you, those 80-year ladies were so happy. They complimented me within seconds. Your business should be such simple lines to be understood by anybody. And the business model out there is, if I invested in a business at a $10 million valuation, $1 million, after 5 years, I've sold at $50 million. I've made the money go from $1 million to $5 million. So I've made a profit of $4 million in that. The profit that I make, my investor, without doing anything, they can sleep happily, they can roam around all over the world. They will get 80% share of the profit. I'll get 20% carried shares. So 20% of that capital gain will come to me. When does that come to me? Only when I sell. And when do I sell? It takes 5, 7, 8, 10 years. And that's the reason we say, if you want to work for a venture capitalist, money will not be made in 1, 2, 4, 5 years. It'll be made in 8, 9, 10th year. Got it? So that's the business model of a venture capitalist. Investor rights, the most important right that we take. That after 5 years, you must give me the exit. I must be able to sell my shares to somebody who's doing better than me, who wants to come in at that stage. And if in 6 months' time, after 5 years period, nobody buys my shares, I have a drag along right. I can sell your entire business for pennies or for whatever price to a third party to get my cash out. Imagine the investor rights that you're giving. It's not easy to take money from somebody else. Money comes with strong investor rights. So the strongest investor right is drag along right. Yeah.
By the drag along right that you've mentioned, does that mean that you have the right to sell the entire business, like the shares of the other person as well, or only yours? Because if you sell your own shares at pennies, you won't get your cash out, right?
So by selling my own shares, I can sell my own shares anytime. First year, second year, third year, fourth year, fifth year, sixth year, whatever time I want to sell, I'm free to sell my shares. But if the entrepreneur is not able to give me the exit after the end of 5 to 6 years, whatever we have signed up, then I have a right to sell entire company to a third party. That's the reason all global companies they are friends with us. Google, Microsoft, IBM, every company is a friends with us because they know there'll be someday their good companies will be acquired, will be coming to be sold to them. So that's the pipeline of innovation for them. Yeah.
So another venture capital firm that came a long time back to Ashoka said that if they're not able to sell their stake, that's actually money lost. Like that money is sometimes well, it's sort of like a sunk investment or something. They like, is that also something that happens? Like, or do all investments have a drag along clause in them?
See, that happens in most of the cases, money being lost. I'll give an example. We are investing at a very early stage in a business. Only customer validation is there, and maybe sometimes idea stage. So risk is very, very high. So what happens is nearly 50% of the portfolio does not perform. If the idea does, means let's say I've invested in that 15 minutes recharge, okay, and charging technology. If the idea doesn't work out, who will buy out? Nobody will buy out that particular asset. So it's a sunk investment. You have to take a write-off. The good part of this business is that the innovation that we go after, or the companies and the founders that we invest in, the 30 to 40% of the money that does well, that money becomes 20 times, 15 times, 10 times. It becomes so much bigger that overall portfolio does well for us. So when you are coming as a second stage VC, we will negotiate that when will the drag along clause trigger between both of us, whether both of us have to say yes to drag along or one of us says yes to drag along, that is signed and sealed at the time of your investment coming in. So no ambiguity. There has to be a clarity for every aspect of it. My boss used to tell me in Bharti Airtel that anybody walks into a room only when they know there is an exit gate. So anybody invests in your company only when they know there is an exit route available. When you're signing partnership, one of the big reasons with the startups fail because of the founder conflict. And why the founder conflict happens? Because you have not clearly defined every aspect of your working relationship. While you may be investing at the same value in the company, let's say there are three partners, all three partners came at the same value, invested in the company at the same time. If you have not signed exit clauses between yourself, exit clauses to the extent that if I'm no more tomorrow, what will happen to my shareholding? What will happen to my rights? The founder agreements have to be even better than the shareholder agreement of VCs when we are investing in. If I stop working in the company, what will happen to my shareholding? Okay. And if I want to voluntarily exit, okay, let's say my family says that you cannot do a startup, you need to exit. So at that particular point in time, at what valuation my partners will buy that share, the company will buy that shares. All that has to be clearly defined at the beginning. That's the purpose of valuation. Yeah.
So coming back to that question, so the sunk investment only happens after you're not able to get any money back from the drag along?
Yeah. No. Yes, that is one way of looking at that. The business is such that there is no realizable value of the business. Hence, we have to take a write-off.
And let's say I have a company, you invested in it, and you are unable to sell your stake, but my company is profitable, but nobody's willing to buy it. Can you still drag me along and make me sell my entire company?
Yes, that's the purpose of that clause, that I'm not able to sell my 15-20% stake to a third party, but somebody is interested to acquire 100% of the company. So we will sell 100% of the company. For selling that, obviously I have to take you in cognizance, because when I invested in you, I explained to you that this is the term that you're signing. So I conceptualized my fund in 2011. And for 35 days, I was on the road only meeting. I would have met around 45 angels, VCs, private equity guys at that particular point in time. I was doing research whether my venture capital firm can be a viable thing and what do I learn from those guys. In those 45 meetings, I met most of the people who were taking majority controls in their businesses. They said, I will only invest in a startup if I get 51% stake in the company. I said, why do you want to do that? He says, Indian laws don't allow me to drag along the business. So tomorrow when I want to sell 100%, the promoter can create a fuss about it. Hence, I will invest only if I get 51% stake. But that was not the model that I wanted to pursue. I wanted to give the freedom to the entrepreneur and clearly have a long path and long equity with him for him to be grow. I want to be happy with the minority stakeholder. So to be happy with the minority stakeholders, we have that drag along clause out there.
So let's say you're not able to sell it. Do I have the option of buying back your?
Oh yes, we give you 6 months to buy us back.
Okay, but so in this often what happens is the company is profitable, but you are not able to exit. So the
yes. So some founders are very, very smart. The beginning, I gave an example of a 400 crore and a 1,000 crore gap. This guy came up with the clauses and foundings, etc., that they buy back some old shareholders at 200 crore valuation. They will buy back some other shareholder at this value, and hence the founder who was in control of the business will get 1,000 crore valuation for that company. So that's how he smartly did it. No, there is return expected for us is always the internal rate of return that we expect from a venture as a venture capitalist is minimum 25% dollar terms, minimum. Normally, our expectation is 40% plus return from any investment.
Even the entire company. In that case, do you also take personal guarantee or something?
No, 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 no.
Oh,
See, the entrepreneur has to be free. We will not take any personal guarantees from you. We will not disturb your life. You should not be at feeling कि कल को business fail हो गया तो तुम्हारे घर के assets, family के assets, सब everything will be going back into no. We don't touch that. We want your mind to be free to build that business.
But this 25% isn't it very high, steep for the early stage?
सर आप बताइए, मैं तो 36% रिटर्न दे रहा हूँ, मेरे पास इन्वेस्ट कर दीजिए आप. हाँ, अब मैं जब आपके पास आऊंगा कि मेरे पास 1 करोड़ का चेक लिखिए, तो यू विल से यार सुनील 1 करोड़ मैं नहीं फंसाना चाहता 8-10 साल के लिए, तो मेरे को तो लिक्विडिटी चाहिए. तो मैं कहूंगा नहीं साहब, मैं तो बहुत अच्छी रिटर्न दूंगा, मैं 25% दूंगा. आप कहेंगे ना 15-20% तो मैं स्टॉक मार्केट में कमा लेता हूँ, तो व्हाई शुड आई इन्वेस्ट विद यू? सो nobody gives me money. I have 350 investors in my 3 funds. Okay, we manage around 1,000 crores of rupees, but for me to go and collect money, even when I'm delivering 36% return, tough. Because people say, yeah, I don't want to block my money for 7, 8, 10 years. So as a startup entrepreneur, you need to understand where the money is coming from. It's not a bank who's putting in money. It's a venture capitalist who's putting in money.
Like in this case of the example that you gave for the person who was in Bangalore and trying to make 15 minutes charger, and you invested 1 million at $3.7 million.
Yeah.
So at the next valuation, when you gave him a much higher valuation, so did he provide that much return? How did you calculate that return?
No, he didn't know return provided. It is just that our money is still invested with them.
Okay.
Okay, we continue to invest more. This is like the founder has kept the promise every time. And hence we are writing more and more and bigger and bigger, more and more investment. Nothing has come back to us.
What kind of promise did he keep? Like, was it with
respect
to returns or was it
no,
to the...
He made the product. He demonstrated that it can happen. The technology can happen. It's good enough for us.
That's captured somewhere in the documents?
Oh, yeah. Whenever I write next check, the percentage of ownership is lower. So, incremental ownership is lesser because the valuation is jumping so much. Yeah. Okay. Startup valuation is becoming very, very important. So until now, I was talking about the concepts behind idea stage, startup, whatever you read in newspapers. Now, the tough topic starts. How do you value every business? So the general talk of Gyan of startups, I believe you've understood. If any questions on a startup valuation so far, before I go into every business, which will include even startups. Now you get some familiar charts. This is what you get to see in your books of economics and finance and financial management. There are 4 stages that we have captured. Until now, I was talking to you a startup stage, which is C to Series A. Next stage is an exponential growth, which is Series B, C, D, E, F kind of thing the company is growing. Then there is a private equity guy coming in a stable business where the predictability of revenue is there, business is growing leaps and bounds, and listed businesses. So companies which are listed where mutual fund investments are done by you. This is this particular space. And then there is a space when the business becomes a lifestyle business. That means the earning from there is just growing with the economy or may not be growing also. So the business is now stagnating. In each stage, there is a different way to value the business. If the business is not growing, okay, or business is dependent on you being there. Some of you must have seen there are chartered accountants, professionals, architects, law firms, etc. The valuation of those businesses, if they are individually run, is negligible. It is equal to the 400 rupees cash in their books. It is equal to the net asset value. What is net asset value? The money in the bank account. That is the value of that business. Nothing beyond. Yeah, sorry, you had a question.
could you give some examples of some lifestyle companies?
Oh, yeah, yeah. The way I said, a CA firm, okay, a consulting firm, or there is no moat, there is a manufacturing business, okay. You're doing job work for, let's say, Dabur, you're doing job work for Levers, you're doing job work for this thing, but you don't have a brand, you don't have any identity, only on relationships or so, you have got the business coming in. You're doing efficiently, you're doing the production efficiently, but because you don't have any moat, any differentiation, you may not be able to become big, large, or the business may not be sustainable. Hence, it is a lifestyle business. And there are lifestyle businesses, are wonderful business to be in. I'll give some example. There are SaaS companies, software as a service SaaS companies, which has revenues of 25 crores or 30 crores. They are from Chandigarh, Indore, Coimbatore, etc. And these companies, their cost is hardly 5, 10, 15 crores. They make a net profit of 10, 15 crores every year. Is that a bad business? That's a beautifully run, bootstrapped business, 100% owned by you. No need to go to a VC. You're living a very comfortable life. You're enjoying everything in the life. Those are lifestyle businesses. But we hate lifestyle businesses because if there's a lifestyle business, we won't be able to sell that business. Nobody will come and buy that business. So we don't invest in lifestyle businesses. This is the listed market that you get to see in the stock market every now and then. How they're here. You've seen last 5 years profit, 10 years profit. You've seen the growth. You know how predictable the growth is. Infosys will say, my expected revenue growth next year is 10%. Variability would be as against 10, it can be 9 or 11. So you can do that particular variability and do a discounted cash flow. We will talk about it. Or you can do a price to earning multiple that somebody else is valued so much. So that is the value that I'll give. And there's a premium of liquidity. So that's how you will value that asset. Premium of liquidity is, so, when I said you invest with the venture capitalist, the money is stuck for 8 to 10 years, you won't invest with me. But if you have to invest with the listed market, I know next day morning when I need the money, I can sell. That's the premium of liquidity. Okay. Now, the exponential growth businesses. There is hardly any profit, but there is some kind of EBITDA out there. There is a revenue. What do you calculate? Enterprise value, EV. Anybody can explain what is enterprise value?
The sum of the present value of the terminal value and the free cash flows present discounted to the present.
Okay, explain further. There is something missing. Let's say, there are two listed stocks. These days, one stock price is moving very much, which is Idea. Vodafone Idea stock price is moving quite a bit. And there's a listed stock of Bharti Airtel. Now, how do you compare the value of those two things? Bharti Airtel is trading at 900 rupees and Idea is trading at 1400 rupees. How do you compare those two shares? Which one to invest in and which one to hold? So go beyond. You computed the present value. Yes, there's a.
So like in the market capitalization, you add the outstanding debt and then you subtract the available cash. So it's like a better metric.
Wonderful answer. Okay. If you have to buy the entire company, who do you pay for? You have to pay all the shareholders and you have to pay all the bondholders. Whoever given money, whatever money has been given to that company by creditors and by shareholders, if you have to buy that asset, how much money you have to pay for that asset. Now, at 14 rupees Idea, with the number of shares outstanding, if I multiply, equity value, which is also known as market capitalization, is 70,000 crores today. But they have a debt of how much? 230,000 crores. So the enterprise value of Idea is 3 lakh crores. Got it? And Airtel, which is trading at 900 rupees, by multiplying with the number of shares, the market capitalization or equity value is around 6 lakhs crores. And the creditors, the debtor, the creditors in the book are 3 lakh crores. So the enterprise value of Airtel is 9 lakh crores. Now it is easier for you to understand somebody who's a market leader, profitably run business, very good. It is valued at 9 lakh crores. And somebody who's loss making and we don't know about the future is valued at 3 lakh crores. It's not the ratio is between 900 rupees and 14 rupees. The ratio is between 9 lakh crore and 3 lakh crore. That's the understanding that you need to have whenever you're doing any valuation. So enterprise value, that enterprise value can be divided by revenue to see what is the revenue multiple that market is paying, or it could be divided by EBITDA, which is the earning before depreciation, amortization, and taxes. That's the exponential growth. And what factors we look at? We look at the core business. In case of listed companies, we look at cash flow. There's a moat. What is the product differentiation out there? In case of exponential growth, we look at sales growth. There's a terminology written out there, T2, D3. Anybody, any idea? T2, D3, exponential growth. You know what our expectation is? The revenue will triple for the next 2 years minimum, and revenue will double for the next 3 years. Imagine somebody comes to me and says, I have $1 million revenue business, but it'll grow, it'll triple to 3 million to 9 million in the next 2 years, and then 2x, 2x, 2x. So from 9 million to 18, 18 to 36, 36 to $72 million. I will pay an amazing value for that business because, you know, from $1 million revenue, it can become $72 million revenue just because of the brand pull that is there. If I have to push the product, the valuation would be lower. If there's a brand pull, the valuation would be higher. And then business model. We pay value to only those businesses where customer pays money in advance. Let me give an example from your word. I worked for Dabur for 10 years. And then comes Flipkart. And the value of Flipkart on the day it got into being, means within few years, was higher than Dabur. Here's a brand, good business running for 120 years, and the value of Dabur's business is lower than the Flipkart, which is making losses. What is the difference? Means I had to think through what is the difference between the two, that the valuation of Flipkart is higher than Dabur. A sustainable, proven business, well executed, generating cash flows is lower than a loss-making business of Flipkart. Only one difference. If you're able to think of business models like that, that in case of Dabur, the customer pays money or the Dabur gets money from a distributor or retailer after 60, 90 days or 30 days. Whereas in case of Flipkart, the money is paid by us in advance. We trust the brand so much that we make the advance payment or we make cash on delivery. Never ever credit on Flipkart. If your time is not being wasted on collecting money, imagine the power of that brand. So that's how, if you're able to get advance payment from the customers, it is valuable. That means your product differentiation, so your trust in the brand is so much that you can get that kind of money in advance. And the earlier one we've already talked about quite a bit, so I will skip the first part of the startup thing. Any questions out here? We will go into illustrations of this chart. How much time we have? So, shall we? Aha. Ready? So whatever we've listened today, some examples will be coming in from there. Now, two of your friends, you start a business. You incorporate a private limited company. Because if you need to raise money from external world, best is to have a private limited company. And you must have read a part of Companies Act, company law, or something like this. Okay, what you need to be looking at, let's say you are valuing your company at 1 lakh of rupees and you're putting in 50,000 rupees each to start the business. And normally in India, the face value of the share is 10 rupees. That means you are issuing 5,000 shares to yourself at 10 rupees face value, and 5,000 shares are being issued to the founder B. Total number of shares in the company are 10,000. And you've invested 50,000 rupees each. And the face value is 10 rupees. Very simple. In a Companies Act, what is the company about? Company is given a right equivalent to a human being. Whatever rights you have as an individual, company has similar rights. Company can sign post the age of 18, we can sign contracts under the Contract Act. Company from day one can sign a contract. That means there has to be company has an identity of its own. And the identity is driven by board. And the board is controlled by shareholders. And the shareholder in this case is the founder A and founder B. This is the most important thing that you have to control, that you can control a board by your shareholding easily. So here 50% shareholding in the business. Okay. Now, read this. They've got an offer. They've got an offer. Their idea is very wonderful. Their idea is good. Somebody says that I'm investing 50 lakhs of rupees, and this is friends and family. They pitched, and the friends and family says, I'll invest 50 lakhs of rupees for 20% stake in your future profits, or 20% stake in your company. Question is, in this example, what is the pre-money valuation? What is the post-money valuation? Think. Somebody is putting in 50 lakhs in your business, and what will be the revised shareholding? So first only focus on pre-money and post-money valuation. 1 lakh is pre-money and 2.5 lakh is post-money. This guy needs to come and explain for me now. Come. Oh, now there is an answer that comes in. The post-money valuation of 2.5 crores. Explain how did you compute? Anybody who's not understood this particular math, that the post-money valuation in this company, where you happen to put in 50,000, a lakh of rupees, only 1 lakh of rupees, just by sharing your idea with friends and family who are ready to put 50 lakhs or 20% stake in the company, now the post-money value of your company is 2.5 crores. And what is the pre-money valuation then? Okay. Explain why should not be 3 or why should it be 2.5?
I think that the pre-valuation would be 2.5 CR because 50 lakhs for 20%. So for the 100% of the company is valued at 2.5 CR. And then PMV, post-money valuation, is calculated by the money put in plus the...
Okay. Now we go back to the 100 rupee note example. I had 400 rupees in my company and I got 100 rupees as fresh investment. My shareholding in that company was how much?
20%.
20% because 500 rupees was the post-money valuation. 100 rupees divided by 500 was 20%. The moment you do 3 crores, I've invested 50 lakhs with you. 50 lakhs divided by 3 crores, my shareholding goes down to 16%. Okay.
2 CR and 2.5 CR.
Yes. So 2 crore is a pre-money valuation. Guys, the concepts that I'm telling you are not understood by practicing qualified chartered accountants with even 10 years of experience. These are the simple concepts, logical concepts. There is no science behind it. Very, very simple concept that in this example, the pre-money is 2 crores and post-money is 2.5 crores. Now, can somebody tell me as to what is the revised shareholding pattern? 40, 40, 20. How many shares will be issued to the friends and family in this example? Huh? ये देखो सेम एग्जाम आंसर देते हैं जो मेरे को सारे क्वालिफाइड चार्टर्ड अकाउंट देते हैं, ऐसे ही आंसर देते हैं 2000. Somebody has a different answer? Think through now. You know, this is your company. To friends and family, the founders, the founders are giving 5 lakh shares, and you own only 5,000 shares in the company. So what becomes the total number of shares in the company is now 5,10,000. Your ownership would be 10,000 divided by 5,10,000. Very minor shareholding in the company if you give them 5 lakh shares. Huh? 2,000, no.
24,000.
No. Yes.
2,500.
How did you compute that?
Because after the post-money valuation, the number of shares should be, for example, the founders at 40% each, and the number of shares are fixed because while issuing new shares, you add shares. And then initially they both had 5,000 shares each, and the value of 5,000 shares is 40%. So for 20%, it's half of 5,000.
No. इसको simple समझते हैं. This is the right answer. That means 2,500 shares will be given to the third party. That means your original shareholding was 5,000, 5,000, 10,000. 2,500 have been given to friends and family. So the total number of shares in the company are 12,500. 12,500 ka 20% is 2,500 shares given to the friends and family. And you wanted to give 20% of that. How do you do in an easy manner? You say, Are, mere company ki without the money coming in, the value was 2 crores. 2 crores divided by 10,000. The share price comes to. So share price is not 10 rupees because the company's pre-money valuation is now 2 crores. 2 crores divided by 10,000 shares. The share price is 2,000 rupees at which you are issuing the shares. So 50 lakhs divided by 2,000 is 2,500. So various ways to compute that same stuff. So these are the number of shares that we need to be issuing. The first status was on the left-hand side, and the second status is on the right-hand side. If somebody has not understood, please raise your hands. Still seek clarity. How's the pre-money has gone up because you've invested only 1 lakh of rupees? How somebody is giving 2 crores? Because somebody's seen your face here. Beauty lies in the eyes of the beholder. Somebody says, this guy can do it, yaar. This guy has the capability. The idea is so good that I'm ready to value this particular company at 2 crore of rupees. So it's a power of your idea, power of your thought, power of your vision, power of your leadership team, power of the product differentiation that you're bringing in, that your friends and family are valuing at 2 crores. Until that time, somebody was ready to invest in that company. The value of the company was 1 lakh. But the moment somebody is ready to invest 50 lakhs or 20%, the pre-money valuation of those shares become 2 crores. Yes. Once the fresh money has come in. Simple. The shareholding of yours is becoming 40, 40, 20. So you've diluted 20% of the company. Correct? Now, we take an example of a predictable phase. Okay. Let me give you an example here. Predictable phase means that there is already revenue, there is already profit, there is already EBITDA. Hence, we are able to do these multiples. Now, how do we arrive at these multiples? I gave an example of Vodafone Idea versus Bharti Airtel. What did I do? I selected a comparable company on account of it's the same industry, similar market size, stage of the business, the similar like business, and hence I've done a comparable companies method. If EV to revenue of Idea is so much, EV to revenue of Airtel is so much, is it comparable, not comparable, etc. is the thing that we did out there. So the metrics get taken based on date of comparison as to during that period, what was the comparables around of that company. And the second method is at what comparable multiple some transaction has happened in the market. Let's say, this guy, I think Flipkart happened to buy Jabong at particular point in time, or they bought another Myntra. Okay, so people will say Flipkart bought Myntra at so and so revenue multiple, so my company's valuation is also so. So my revenue is so much, multiple of that is so much. So that's a comparable valuation for a basis of transaction that has taken place. Before I come to the numbers out there, let me share a case study with you. I was 22 years old when I joined Dabur in 1990. For 5 years, we continued to grow our revenue 25% year on year. Our profit was growing 40% year on year. We were on cloud 9. In 1995, I wanted to do an IPO of the company. And as a cloud 9, I went to the investors and said, we are outperforming Hindustan Lever, we are outperforming PNG, we are outperforming everybody. They are growing at 10, 11%. We are growing 25%. And our profit is growing 40%. You know, the market slapped me. And what could be the reason the market slapped me? They said, Dabur ko dhanda karna nahi aata. You don't know how to do business. Even if your profit is growing 40% year on year, the amount of capital you're deploying to earn that money is disproportionately higher. Your money that is being stuck in debtors and inventories is much higher. The investment that you're making to earn that money is much higher. Levers works on negative working capital. That means the distributor pays them or a retailer pays them within 5 days or in advance. Where in case of Dabur, you get the money after 30 to 90 days. So whatever money you are earning, what you're not earning, free cash flow. So even if your revenues are jumping, your profit is jumping. If again, after out of that profit, you're investing back more money into the business, there is no money left for you to take back home as dividends. That's not the business to be in. So we had to change our business model. From that day, I started going and giving lectures to all our salespeople that the working capital has to be reduced. Working capital has to be reduced. This is how Levers does it. This is how he does it. And hence, we reduce the working capital, then our valuation will go up. Okay. What is important lesson here? For valuation, nothing matters. Only annual free cash flow matters. Yaad rahega hamesha? And the question that was being asked. Okay, now we come to that how do you determine the discount rate for discounting those free cash flows? There was that question about the external rate of return. There is that external rate of return is equal to weighted average cost of capital. That means if I have a money today in my pocket, where do I invest that money? What will I earn from that money? That is my cost of capital. This weighted average cost of capital is my cost of capital that I can earn sitting at home 7.4% return without doing anything. And with the market risk, if I invest in the Nasdaq or a Sensex, with the market risk I take, maybe I'll be able to earn double of that. So let's say it is 7%, I'll be able to earn 14%. So with the market risk, my return is 14%. Now the person says, यार मैं तो तभी इन्वेस्ट करूंगा तुम्हारे बिजनेस में अगर 14% से ज्यादा रिटर्न होगा. And if the risk is the same as market risk, but if the market risk is higher, then I want higher return. How do you compute the market risk? There's a terminology called beta. कि index में invest किया तो return is 1x. Beta is 1. But अगर मैंने a stock which moves too much, variability is too much, that means I would have 1.5x or 2x beta risk. If my risk is lower, it is Unilever or PNG, etc., I'll have a lower expectation of returns from there. Market may be paying 15%, but I'm happy with 11% return from Hindustan Lever stock. So weighted average cost of capital changes along with the market risk, which is represented by beta, and beta could be, it should be around 1, it could be 2, it could be 1.5, 1.1, it could be 0.7, 0.6, depending on the fluctuability and variability of that predictability of the cash flows.
So I had a follow-up. I don't know if this further complicates it or not.
Please, please.
But from what I read, like there was a difference in beta unlevered and there was a normal beta value as well. What is all of that? Like how is this? Because the calculation I'm seeing over here is different from what I remember doing. And I was very confused at that time also. I'd asked the person who I was interning with and they said every time nahi hai.
Okay.
So
हमारे पास बहुत time अभी. Okay. Now, he's used a word unlevered beta. Okay. कोई explain कर सकता है unlevered और levered beta में क्या अंतर हो सकता है? What is the difference? Have you come across a terminology called financial leverage? What is that financial leverage? मैं बताता हूं आपको. There are two kinds of leverages in the business. One is operating leverage, कि धंधा करने में कितना रिस्क है, which is predictability of those cash flows. अब I know my rental income from my house is going to be consistent, less a certain amount of money. There is no risk out there. Operating leverage is stable. Now to finance that house, you've done a financial leveraging. That means, let's say you bought a house for 1 crore rupees. All that 1 crore rupees was from your own pocket. There was no financial leverage. It was an operating leverage. It was just that asset risk was there. And that asset risk was secured by that. If let's say you've given it to a bank on a 9-year long lease, you're now certain about the interest. So operating leverage risk is gone with that particular bank, the property given a rental to a bank. Now you've gone and financed that 1 crore of asset with, let's say, by leveraging it. 50% of that money you borrowed from bank. Okay. So 50 lakhs of your money, 50 lakhs is bank's money. You've added risk to your asset. Okay. And the risk, that leverage that you've done, okay. Unlevered beta is when you have not, when 1 crore is your own. But now, let's say 50 lakhs is yours, 50 lakhs is somebody else. Tomorrow, for some reason, the bank does not pay rental on time. What risk you're running? You may not be able to pay your EMIs to the bank. So you've added a risk to the thing. And that risk factor, there is a cost of debt. So the levered beta is that you adjust the cost of the debt. How do I explain that to you? 15%, let's say, was expected from the share market investment. But you happen to borrow 50% of money at, let's say, 10% the cost. So, and that 10% of the cost is much lesser than 15% expected. So even if you earn blended 7.5 plus 5, 12%, you are happy because you have leveraged it with a lower cost debt. So with your own money, you were expecting 15% return. With the blended money, you're expecting a lower return. So your cost of capital goes down with debt, provided the cost of debt is lower than your expected return.
So this entire part, cost of debt ka jo part hai, that's basically a levered beta.
Yes, levered
So
beta.
when we have to calculate, for example, agar aap discount rate, assume maybe like 12.5%, whatever I remember, those were the figures at that time. So your risk premium, you had said, like beta generally 1 to 2,
yeah.
Risk premium about 6%, and risk-free rate is your FD. So that's about 5-6%. And that remaining fraction of 0.7 or 0.5, whatever comes, depending on the number, that is the levered beta. Is that how it works?
Quite right. Pranav, you want to take that thing? Take this example with them.
So I'll just go a little back to the concepts. So what is beta first? It's the slope. When you're comparing your individual returns of a certain stock or a certain investment you've made versus the market, it's communicated through a graph. That graph, it's quantified as a beta, right? Now, beta is basically comparing a stock's returns against the market's returns. You can't have any of that for a debt, right? Because it's consistent. There is no element of risk which is involved. So beta does not matter out here. So what we're doing out here is we're trying to make sure that the beta aspect is only coming here in the cost of equity. And here there is no aspect of beta. So beta is increasing my cost of risk, whereas there's no cost of risk out here from a beta perspective when I'm comparing it against the market's returns. So that is the difference which is there between cost of equity and cost of debt. And because the cost of debt is usually lower than the cost of equity, the reason being that there is a certain element of consistency. You will not see any fluctuations in your interest rates. More often than not, they're fixed. And because they're fixed, the cost or the opportunity cost which a lender expects from you is a lot lower. Beyond that, it's also secured, and there are various other aspects in a transaction or in an agreement which are involved, which reduce the quantum of risk which is there. And that is why people use the concept of weighted average cost of capital, wherein I can use equity, but also if I'm confident that I can repay my debt amount, I would prefer a lower cost of opportunity cost of capital, which helps me in optimizing my financing that I'm securing from any lender or investor or any person who's putting money in my business. Because money in my business can come in the form of equity or in the form of debt. So conceptually, this is what it is. As far as levered beta and unlevered beta is concerned, there's a mathematical formula around it, which is very simple. But I don't want to complicate it for you guys, so I'll just skip it for now.
But concept is that there is a debt. Means you're buying an asset, you're buying a house, 100% of your money. And the moment you say, okay, I'm borrowing at 7%, but I'm earning 15% out there, you will keep borrowing more and more money out there to still keep on investing in that asset. So this is the example. Let's say risk-free rate of return is 8%. Beta in the market is 1, and equivalent to 1, there is a risk premium of 7%. That means in the market, I'm expecting 8% plus 1x of 7, 15% return. So that's my return expected from a normal market risk return. However, if I'm investing in an early stage startup, I would say my beta is twice than the market. If it is twice the market, then it will become 7 will be multiplied twice. So it is 8 plus 14, 22% is the minimum return expected by me if I'm investing in stock market. So that's how the return expectation goes up. Then there is a yield on debt. There is a rate of interest on tax, cost of debt, and basis that weighted average cost of this thing is computed. But for you right now, just stop at 22%. That the moment risk is higher, your expected rate of return or weighted average cost of capital goes up. Just familiarize yourself with this sheet. Don't be. This is like every year, how much money you're making. You're investing 10 crores, you're not making anything. You're making 5 crores, 10 crores, 20 crores in a year, every year. And at the end of the year, let's say there are terminal values 106 crores. Okay. The discount factor is there. Okay. Basis that 24.2%. That means the 20 crore that you will earn 5 years later, uski present value, looking at cost of your capital of 24.8 is 6.6 crores. Somebody says, I'll give you 20 crores after 5 years, but your cost of capital is 24.8 or your external rate of return is 24.8. For you, it's worth only 6.6 crores. Okay, that is added up, basis that the present value is computed, and basis that the number of shares, the share price is computed. This is how you will come across DCF Excel sheets any point in time. The present value of free cash flows. Okay, this 5.29 is the addition of these 5 numbers. Okay, so you add 6 plus 4, 10, 11, 12, 13, 13 minus 8. 5 crore is the present value of the 5-year cash flows. Got it? And then to that, the terminal of 35 crores, उस terminal value को भी 6 साल का discount कर लिया. एक 6 साल के बाद 106 crore मिलेंगे. उसकी आज की कीमत मेरे लिए 35 crores है. Plus, she had talked about cash in hand, okay, while reducing debt. So you add cash in hand because cash तो पड़ा है books में. अगर 1 crore cash पड़ा हुआ है, the value of the company is 41.3 crores in this example. So if that is a value, that is a discounted cash flow, less than the number of shares in the company were 10,000 only. So now, if your business outlook, your DCF is this, you won't take money at 2 crore pre-money. You will ask for money at 41 crore pre-money. Provided you can convince that this cash flows will come. Aha. Example of valuing a lifestyle business, a saturated business. Anybody wants to guess it before I go to the illustration? We talked about it a while back. Cash in hand, value of the assets in the company. That's the value. There is no future cash flow, nothing. I know tomorrow, if you're not there in the business will die out. It's a consulting business, it's a professional business, it is whatever. There is a manufacturing business. Whatever is the cash in the books, that is the value of that business. And how do you calculate that? You look at all the liabilities, you look at the assets. So asset minus liabilities is the book value. That is what you pay for it. Okay, you say in the books, I have a cash, I have investments, I have inventory, I have debtors. They're worth, let's say, 5 crore rupees. I have a amount payable to the bank of 1 crore rupees. After paying the bank, net money will be left in the business is 4 crores. Your business is 4 crores. Many friends come to me. They say, Sunil, 25 साल काम कर लिया, लेकिन कोई valuation ही नहीं है मेरी business की. Because they never run that business as an entrepreneur. They did not hire talent, a business that can run without them. Okay. They never created a differentiation. They never created a brand. Because they've not created a brand, the brand pull, etc., there is no value. So it's a lifestyle business. It has to be valued in this particular manner only. Do you have a time to do a case study? Okay, I've talked about these companies. These are live investments done by us in the last 4 or 5 years. Okay, any company that you want to pick and who you want me to talk about it, you can see the value at which we have invested in them. You want to take Cron? Cron AI, we invested in 2017. At a valuation of 12 crores, we invested 3 crores in the company. And this company, when it came to us, they said, we will do, the world runs autonomous cars on LiDAR, on radar-based technology. We will use LiDARs to bring efficiency in the autonomous car running. And we will build a perception layer if anybody is coming in front of us. At that time, the use case was defense on India-Pakistan border, or India-Nepal border, Bangladesh border. This company started installing these laser-based installations. Anybody who was coming from the other side, the message used to go to the jockey out there for us to go and attack. There was no need to patrol the border all the time and be in the line of firing of the enemy territory. This company happened to demonstrate, and we invested at that valuation at that time. They had the defense contract. They happened to, then the defense payments never came in. Then we have to reinvent the business model. Now they're only working for autonomous cars. Worldwide customers are there. Right now, somebody is investing in this company at some $40 million valuation. 40 into 80 rupees is, let's say, 280 crore valuation. So we started investing at 12 crore valuation. So this is the very early stage product that we invested in. The valuation of one company, Vyome, we invested at 126 crores. So 10 times the valuation. Why would I invest in a company when I can invest in companies at the valuation of 10 crores, 12 crores, 15 crores, etc.? And here I'm investing last year at 126 crore valuation. You know what these guys came and said? They said, we will give broadband internet at 10 rupees a day at 100 Mbps speed, unlimited amount of bandwidth. We all think that broadband is available to everybody. Why there's a need for another startup to come and give a broadband, and that too at that economical rate? Because most of our people do not have home broadband. They're living on mobile internet right now. Home broadband penetration in India is only 9% as of today. When we invested, it was 7.5%. That means if a person goes the mobile phone, smartphone moves out of the home, the rest of the family is disconnected with the world. Imagine 300 rupees per month the person pays, and the mobile smartphone moves, the children and the wife after that, in that particular home, are deprived of internet. And internet is a basic need these days. And this company says, I'll create 50 million broadband hotspots in the country. And that is the ambition. The government says, just the way they've done UPI movement in payments, we will do the broadband movement by making broadband be available at 10 rupees a day with 50 million hotspots. Yes. You know, there are business model innovations that people do. These guys have done a business model innovation by buying the broadband from Jio and ISPs. There are 500 ISPs. We buy that broadband at 130 rupees a month, and we sell to these homes at 450 rupees a month. No towers, nothing. There is already enough bandwidth available. So we just buy from the ISPs and go to the consumers, pre-package it in a manner that it is available to them under a particular license from the government of India, which is PM WANI. They are installing routers, but that router has such security features that people passing by the road from your house can also access that broadband. Oh, yes. Multiple houses and multiple people on the street as well. Yes, that's the USP. Nobody can copy because this is one, there is a technology available out there. To get a license from the government of India for this, to demonstrate that you have a secure, it takes 2 years. So I have a 2-year advantage. 2 साल के अंदर I'll be having 5 lakh connections already there. 5 lakhs into 400 rupees per month. Imagine how much money I'll be earning. Okay, so the valuation is dependent on the opportunity. And this gentleman, this company, Viome, they say I own the 70% of my staff is IITs and IIMs. So that's the only people that I'm hiring. Or most of my people are those. So quality of leadership team is very high quality. Perfect. So enough examples, enough stories. Still, we have 5-10 minutes. Any questions more? Yeah. How do my investors earn from me? Very, very important questions, because all of you, I want you to become my investors someday. Okay. And what we do is, SEBI says you can invest minimum 1 crore of rupees with any venture capitalist. And once you've committed 1 crore, we don't take cash from you. We say, you make a commitment of 1 crore with me, I'll take money from you as and when I have a startup identified to invest. So I'll give you a 21-day calendar notice, and I'll take that 1 crore of rupees from you in 4 to 5 years. So normally I draw down that money over a period of 5 years. तो 5 साल में आपसे पैसा लिया, और अगले 5 साल में और 7 साल में I start selling those underlying companies. When I sell that company, I keep 20% with me of the capital gain, 80% with you. So let's say I've made 1 crore ka 5 crores. So I give you 4.2 crores and 80 lakhs with me. That's how the business model works. Okay. So the only aspect is you need to have surplus money that you don't need for the next 8-10 years. Then only you can invest with a venture capitalist or in a startup.
If a company can be valued using, say, a DCF model, or if it's in a stage between the lifestyle stage and the one before it, and it can be valued using a DCF and a net book value model. If there is a lot of variation in these models, how does a venture capital firm identify, or a private equity firm identify which one to use?
This is where the art comes. This is where the negotiation comes. This is where a posturing comes. This is where your body language tells us, okay, कि बस ये बंदा तो NAV पे बेच देगा. इसकी तो हालत इतनी टाइट है कि इसके घर वाले कह रहे बिजनेस बंद करो और घर आओ. So you leave those clues in your body language. And hence, we never send our founders for negotiation. We send an investment banker to negotiate. Third party would not leave any clue to the person who's investing in. So when I'm negotiating, I'm going to be having some intermediary in between, which is investment bankers, to ensure my body language, my urgency, my need to cash is not seen by the other party. And the negotiations are, it's an art. Yesterday I was I actually made a presentation to my boss, ex-board at Bharti Airtel. He's got 4 families put together, 400 crores of rupees. He wanted to buy a company of mine. And सुनील, तेरी तो अर्जेंसी है बेचने की. मैंने कहा तेरे को लग रहा है कि मेरी अर्जेंसी है बेचने की? मेरे को कोई अर्जेंसी नहीं. मेरे पास सोल्यूशन है, मेरी अपनी कंपनी बेच. आप बताइए, आप मेरे को मार्केट में इतना मिल रहा है, अगर आप ज्यादा दोगे तो बात करूंगा, नहीं तो बस. एंड वो भी 1 हफ्ते में बताइए मेरे को, नहीं तो मैं किसी और को बेच रहा हूं. Now look at that body language. The negotiation starts from there. You need to be much smarter. Psychology comes into play for that between NAV to DCF. Tomorrow morning, I'm flying down and I'm going to be talking to a founder of a space tech company. And this founder's birthday is tomorrow. And I'm going there to negotiate valuation. I know his expectation is minimum $20 million. And he's already sent messages to me that there are 2 computing firms who are ready to write a check. That means he's already giving me, putting in that fear of missing out in me, that I should not go and negotiate lower than his expected valuation. But I know I'll start from such rock bottom price because he loves me. He loves us. He loves YourNest. So I'll be able to, we are the only deep tech company fund in the country. We understand deep tech. We understand these things. So we'll be able to get a better pricing from him. Sridhar told me that we must recap the takeaways. Before I write the takeaways, anybody wants to share the takeaways from the session today?
I had one last question. Some PVC firms also use the 220 model for the revenue. So I just wanted to ask this for general knowledge. Does YourNest only charge for capital gains or for the 2% as well?
Hey, we cannot pay salaries to our employees if we do not earn 2% for the first 10, 15 years. So the 2% of the invested committed capital is the management fee that we charge to be able to do the operating expenses of finding those startups, to guide those startups. That 20% share will come after 8, 9, 10 years. So there has to be some subsistence capital. May not be for 2, 3 years. They are private equity guys also ask for a drag along. They say that if you do not do IPO within 2.5, 3 years, then because it's a profitably run company, it's ready for IPO. If you don't do it, then we have the right to sell. Either you do buyback of our shares or we have the right to sell to some strategic player at that particular point in time. This is a very, very tough clause to negotiate there. Even venture capitalists are not for 2 years. Private equity guys are normally for 2, 3 years. No, they then for 2, 3 years, they won't get the drag along right. They won't. Yes. For the first time, we've addressed undergrad students. I want to understand कि कुछ takeaway हुआ, कुछ सीखा. बहुत अच्छे. So spread the word around. Just to recap, we've understood the concept and the principles of valuation. We have now how to do the fundraising. What are the jargons that I use? So jargons we have got familiarized with. We won't be now confused. We know valuation is determined by various external factors and some internal factors, which is the entrepreneur-led and the company-led and the which are in control, which is the aspiration, leadership team, product, etc., etc. And cap table. We've understood the cap table. Cap table is share capital table. There was 5,000 shares, and how when the new investor came, we gave him 2,500 shares. Okay, so understanding of cap table with an example, and during the life cycle of a business, how different valuation methodologies are adopted. So that's a recap for all of you. 8:35, 5 minutes over. Thank you so much.